Welcome to The Explainer. Today we're diving right into the fascinating structural mechanics that distinguish Sukuk from conventional bonds. Now, if you track global financial markets, you already know that Malaysia operates a uniquely fascinating dual capital market. So we're going to unpack the architecture behind these instruments, moving way beyond those surface-level definitions, to see exactly how they're engineered, how they handle risk, and honestly, why the market has so heavily embraced one over the other. Here is our syllabus for today. We're covering the macro context, the fundamental divide, architecture and SVVs, the ownership nuance, risks and dominance, and finally, future horizons. Let's get into it. Section 1. Macro context, Malaysia's dual capital market. To really grasp the sheer stakes here, we have to look at the numbers. The total market size as of April 2026 sits at a staggering 2.3 trillion ringgit. That number highlights the massive, systemic reliance on debt and asset-linked securities for long-term financing in the region. And Malaysia has absolutely solidified its position as the undisputed global leader in Islamic capital markets. We recently saw a massive 24.59% surge in new corporate issuances alone. This is crucial because it's no longer just some niche alternative. It is literally the primary engine of sovereign and corporate financing in the region.
Moving to Section 2, the fundamental contractual divide.
So, what is the actual difference? Well, it boils down to this. Conventional bonds represent a straightforward loan contract. It's a classic creditor-debtor relationship that relies entirely on the issuer's overall creditworthiness. You lend money, you get fixed interest. Sukuk, on the other hand, is fundamentally different. It represents a certificate of ownership tied to a specific Sharia-complying asset or venture. The entire goal here is to completely avoid interest, or riba. You aren't just lending money, you're buying a beneficial stake in an asset that generates its own returns. If we break down the legal DNA, notice how conventional bondholders are classified merely as creditors. They have direct legal recourse to sue the issuer if they default. But on the Sukuk side, investors are part owners or beneficiaries. Their returns are intrinsically linked to the performance or the rental yield of the underlying asset. The governing documents change, the legal recourse changes, literally the entire economic philosophy changes. All right, Section 3, Architecture and SPVs. Let's look under the hood. The absolute secret sauce of this architecture is this special purpose vehicle, or SPV. Unlike your straightforward corporate bonds, Sukuk rely heavily on this independent orphan entity to create a vital bankruptcy firewall. Basically, the asset is transferred off the originator's balance sheet and into the SPV. This ensures that if the originator goes bankrupt, the investors are entirely shielded from the originator's other creditors. The SPV holds the asset in trust, acting as both the issuer and the ultimate safeguard for the investors. Now, before we look at the specific blueprints, we need to quickly define the 5 core Sharia contracts. These are the absolute legal DNA of the SPV framework. They dictate exactly how the cash flows, how assets are managed, and how legal rights are governed. So let's walk through how each one structurally operates out in the market. First up is the Ijara structure, which is essentially a sale and leaseback mechanism. Think of it like selling your house to a trust and then immediately renting it right back. The predictable returns flowing back to investors are actually just regular rental payments. Because lease payments can be fixed, this structure very closely mimics the predictable payout profile of conventional fixed income bonds, which naturally makes it incredibly popular. Next is the Murabaha structure. This is basically a cost-plus sale. The SPV buys an asset with cash and then sells it to the originator at a pre-agreed markup to be paid back later. Again, this creates highly predictable returns for investors. However, because it structurally resembles a debt owed by the originator, it raises some pretty significant debates globally about whether it can be traded in the secondary market. Though it's worth noting, Malaysia adopts a more flexible interpretation that does allow for trading. Then we have Musharaka, which functions as a true joint venture or partnership. Here, profits are shared by a pre-agreed ratio between the originators and the investors. But crucially, look at the risk mechanics. Any losses have to be borne strictly in proportion to each partner's capital investment. This is the absolute embodiment of genuine risk-sharing in Islamic finance. Mudarabah is a bit of a pivot. It's a pure division of labor. Investors provide the cash, acting as the Rab al-Mal, and the originator provides the hustle and management expertise, acting as the Mudarib. If the venture succeeds, profits are shared. But if it fails, assuming there wasn't any negligence by the manager, the financial losses are borne entirely by the investors. The manager simply loses their time and effort. Finally, we have the highly scalable wakala structure. This involves an agency arrangement where investors appoint the SPV as a wakil, or agent, to manage a diversified pool of assets on their behalf. Because it isn't tied down to just one single asset, it offers massive flexibility. In fact, it was famously used by Perusahaan Sukuk Berhad in Malaysia for a massive 10 billion ringgit issuance. Section 4. The ownership nuance, asset-based versus asset-backed. This brings us to a massive debate in the space regarding the spectrum of risk and Sharia authenticity. Right now, the market is completely dominated by asset-based sukuk. These only grant a beneficial interest to the investor and rely heavily on purchase undertakings by the originator. Frankly, they function very similarly to unsecured conventional bonds. On the total opposite end of the spectrum is the authentic, ideal, asset-backed sukuk. This requires a genuine true sale of the asset, granting investors direct recourse to claim the asset if things go south, but it also forces them to genuinely bear the risk of the asset depreciating. Section 5. Risks and dominance. Let's see what the market thinks. So, the risk profiles here diverge pretty sharply. Conventional bonds mostly grapple with interest rate risk and standard credit risk, but Sukuk, they introduce totally distinct variables. You have Sharia non-compliance risk. If the asset breaches religious principles, the whole instrument falls apart. You also have asset performance risk. If the real estate or the venture fails, your returns drop. This requires a much more comprehensive, multi-layered evaluation from the investor compared to traditional fixed income. You have to look at the actual real estate or asset, not just the company's credit score. And yet, despite those complex risks, the market has delivered a definitive verdict. The data shows a massive trajectory for Sukuk. Corporate Sukuk outstanding reached over 806 billion ringgit in April 2026. It is vastly overshadowing the stagnant 135 billion in conventional corporate bonds. The market has overwhelmingly chosen the flexibility, the asset backing, and the broader investor base that Sukuk provides. Finally, Section 6. Future Horizons and the Digital Evolution. The financial architecture we've been talking about today isn't static. It is actively evolving. We are currently observing a very deliberate regulatory push, particularly by AAOFI, to shift the market away from those debt-like asset-based structures toward genuine asset-backed true sales. This is running completely parallel to the massive expansion of ESG and green Sukuk. But honestly, perhaps the most revolutionary shift right now is toward blockchain tokenization. We are looking at a future of digital tokenized bonds and Sukuk that use automated smart contracts for instant settlement and completely frictionless coupon payments. Which brings us to a really fascinating question to leave you with. We know the market prefers the easier asset-based structures right now because genuine, true sales introduce too much legal friction. But as blockchain technology systematically removes the friction of transferring true sales and completely automates trust, will digital tokenization finally force the capital markets to fulfill the authentic risk-sharing promise of true asset-backed Sukuk? It is definitely a structural evolution worth watching closely. Thanks for joining me on this explainer.